Let's take a quick look at risk in the financial market. Market risk or systematic risk. This is risk from being in the financial market, like when changes in interest rates, inflation, and other economic indicators affect the stock price of a company. These risks are not diversifiable. Business risk or unsystematic risk. These risks are from you investing in a specific industry or sector, like when there are new competitors in the market or new technology introduced that can reduce profitability of the company you are investing in. These risks are diversifiable. Systematic risk and unsystematic risk are most relevant in CAPM. Credit risk, risk of borrower unable to make the payment. Liquidity risk, risk associated from bad liquidity. Refinancing risk, the borrower's ability to replace the existing loan. High refinancing risk will give a bad future outlook from your investment. Operational risk, risk from bad decision making in the day-to-day business of a company. Systematic risk, risk of the financial stability in the society to collapse. Political risk, consequences from political decisions. The formula for calculating the unsystematic risk in a stock is by finding the difference between the total risk of an asset and the systematic risk of an asset. And to find the systematic risk, you multiply the stock's beta with the standard deviation of the market. Let's look more into this in our example. Apple has a total risk, which is the variance and standard deviation of 0.096 and 31%. Let's plot Apple's risk into our graph. Select data, add Apple. X value is the standard deviation. Y value is the return. There. The total risk of Apple is its standard deviation, which includes the systematic and unsystematic risk. We can illustrate this by making a line, insert, shapes, from 0 standard deviation to Apple's standard deviation of 31%. Apple's systematic risk, the non-diversifiable risk, can be illustrated by making a line from 0 standard deviation, but we don't yet know the value of Apple's systematic risk, so we will just draw the line up to the market's risk. In this case, the S&P 500 of 15%. Apple's business risk or diversifiable risk will be the line from Apple's systematic risk to Apple's total risk, 21%. So the blue line here is Apple's total risk. Yellow line is its systematic risk. And the red line is the unsystematic risk of Apple. So holding the market portfolio or a well-diversified portfolio, in this case the S&P 500, reduces the unsystematic risk from holding only Apple stock, equals to this red line here. Though the return also reduces from 31.9% to only 9% a year.